Hello and welcome to the next of our recaps. This is a recap of our lecture on the Board of Directors. So thinking first of all about what we're talking about here, remember it's corporate governance. This is section A of the report, the UK Corporate Governance Code. So remember it was an amalgamation of early reports such as Cadbury, and Cadbury outlined the split in the CEO and chairman role. It made sure that the chairman is independent, and we're going to talk about that shortly. Higgs then brought this on to say that half of the board need to be non-executive directors and they need to be appropriately remunerated. Also, it talked about shareholder communication from the board of directors. Tyson then went on to consider the diversity of the non-executive directors and to think about improving the communication between the board and the shareholders. So some of the recent changes that there have been regarding the board of directors, and this is through the FRC report in 2010, the Walker report that we discussed last time, and that's a new code really, but it doesn't change much from the combined code. Some of the revisions that are in there were the name, first of all. It's now called the UK Corporate Governance Code, and it has new sections on leadership and effectiveness of the board. Some of the new principles that are in there, first of all, that the chairman has leadership responsibilities, so that's a core aspect now. Also that the non-executive directors have to challenge the strategy of the organisation. They have to know enough to do that and they have to be able to do that. So they'll need a balance of skills on the board to challenge that strategic direction. Also some time requirements about reporting and communication with shareholders. So some of the things that we need to also know are that, first of all, the directors need to be re-elected annually now under this new report. And then when it comes to the roles and responsibilities in the organisation, well, the board must take responsibility for the following. Entrepreneurial leadership, okay, that's what they do within the organisation. They represent the company to the public. They also determine the strategic aims of the entity. They'll set the value and the standards, and we'll think about that when we look at the control environment in the organisation, and they'll oversee the management. They're responsible for establishing the internal controls, and they must meet regularly to do that. They'll assess the performance and give a balanced view of it, and they'll be re-elected each and every year, as I've just mentioned. So when it comes to actually running the board, well, to be effective, there need to be a few things. First of all, there needs to be a clear strategy. There also needs to be key performance indicators so we can assess how the board has done. We also need to consider all of the stakeholders, and we'll be looking in detail at stakeholders later on in this course. We'll also evaluate the performance of the board because the remuneration of the board must be set based on performance. So to understand that, we need to evaluate it. But the non-executive directors, remember, will rely on management for the information, so that can be a drawback. Also, the meetings aren't all the time, they're occasional, usually at the end of each month, so that might not be enough. And the CEO may well be overbearing and take control. So when it comes to meetings, there should be an agenda to approve decisions. All of the information for the meeting should be distributed in advance, and the meeting should be regular and attended. So look out for things like that when you're looking at a scenario. When it comes to the structure of the board, there's two types. There's a two-tier board, which is a European structure generally, where we have a management board and a supervisory board, and therefore the roles are completely split between the management, who look at the strategy, strategic direction and management of the business, and the supervisory board, who simply supervise. In a unitary board system in the UK and the US, we have a combined board with combined collective responsibility for both of those areas. Remember, we've been talking about non-executive directors, NEDs, and they are there to provide an independent view. So some of the roles of non-executive directors are to advise on the strategy, to scrutinise the performance of the board, to monitor risk, and to appoint the people on the board. So to be effective, those non-executive directors will have to have a few things. They'll have to have sufficient knowledge of the organisation and of the industry. They must insist on an induction, and we'll talk about inductions in a later lecture. They need to know the issues that face the business and the issues that face the industry in which the business is based. They need to demand the information from the executive directors so that they're fully informed, and they need to act in an ethical way. There are some threats, therefore, to non-executive directors, particularly to their independence. First of all, if they've been an employee in the last 5 years, well then they shouldn't be a non-executive director. That would be too much of a threat. Other directorships, particularly cross-directorship, where you are a director of this business and another business, and we have directors on that other business who are directors on our business, so cross-directorships. Also shareholders, when we have directors who are shareholders, that can be a threat. Or if they get other remuneration from the business, that indeed will be a threat to their independence. So we looked at these in detail in illustration 1. So one area that we've already mentioned but we need to understand in detail is the split of the role of chairman and chief executive officer. So remember, the two roles are different. The chairman, well, they run the board. So they provide leadership on the board, they structure the board, they set the agenda for the board, and they distribute the information or make sure that it is distributed. They therefore are there to facilitate the non-executive directors to make sure that they get an input. The chief executive officer, however, they run the company, so they're in the business day to day, and they do this by first of all developing a policy and strategy for the business, by being accountable within the business, managing the resources of the business, supervising the managers, and looking at the budgets and financing of the business. So corporate governance codes say that the role of the chief executive officer and the chairman must be split, i.e. the same person shouldn't hold both roles. Why is that the case? Well, the chairman is supposed to represent the shareholders, therefore there should be clear accountability. So we want to prevent unfettered power. We don't want someone to be in charge of both the board and the strategic direction of the company. That would be too much power and wouldn't be good for shareholders. And remember, the chairman is there to represent those shareholders. So we looked at this issue in detail in illustration 2. So that was a recap of our lecture on the board of directors.